What is going on, ADPI Nation? I'm your host, Kevin Brenner, and you are listening to the Active Duty Passive Income Podcast. If you didn't catch that in the intro, this is the ADPI Podcast. We've been doing it for quite a while, and today's guest was from the way back times, episode 137, way back in April of 2020. And as I say that out loud, I realize I've been doing this for a while. So Ellis Hammond, welcome back to the show, man.
Dude, April 2020. The funny thing about April 2020 is like most of us weren't even wearing pants in April of 2020.
Exactly.
So like,
pandemic, man.
100%, man. So we were doing shows, in our boxer briefs and a shirt. So that's hilarious.
Looking at you now, I don't know if you're actually wearing pants right now. So
I could not be. Listen, it's the summertime. I was looking at your really cool background with your lights and different things. I'm in my garage, like I have all my stuff. It's summertime, so we got family in town, and so, but it's we're having fun, man.
That's awesome. Yeah. So today's episode, we're going to be talking about kind of the multifamily, the cycle, the economy, and for a lot of people listening to the show, obviously, unless you've been like living under a rock for the past 18 months, that even as we record this, what's today's date is the 15th of June. So yesterday, on the 14th of June, the Fed came out and said, no, we're not going to raise interest rates. And that's the first time in 10 months that they did not raise interest rates. They held them steady, about 5.5%, I believe, is the Treasury interest rate right now. And obviously that the raising of interest rates makes lending money much, much more expensive. We're not going to go into kind of the fundamentals so much of what that means, but that's what Investopedia is for. You can go and look that up yourself. But what we want to talk about today, Ellis, is what is going on in the multifamily industry, because there's been a lot of people who have gotten burned, in a lot of syndicators who purchased a lot of deals, and maybe they had bridge debt, maybe they had floating rate bridge debt. We talked about it before, and as interest rates rapidly increased in what's commonly called a Fed tightening, right? A lot of these people who had this floating interest rate debt, they realized very quickly that they're not going to get out from underneath it, and they got to figure out a way to convert to try to do these value add properties and get this figured out. But from your perspective, Ellis, like, where are we in this economic cycle? Is there a light at the end of the tunnel right now with multifamily, or is it like just time to burn the ships and get on the lifeboats?
Depends who you ask, I guess. Depends how deep you're in. Yeah, what's up, everybody? I'm thankful to be here. Kevin, thanks for having me on, man. Think about since 2020, we've purchased more than 1,200 apartment units. We've syndicated, probably $20 million of equity, and probably double than that in fund of funds, co-GPs, et cetera, right? So we've raised a lot of money and bought a lot of deals, and some in good markets, bad markets, so I would just say I share all of that, not to dive into every one of our deals today. But like, I feel like we got a pretty good pulse on what's happening. And then we run a community called Kingdom REI. And so I'm just getting to see, a lot of like what's working, what's not working, where and how are people pivoting to really, I think, survive in this economy. And I would say even the top syndicators, I mean, we're talking about, I think I was just on a podcast the other day with S2, Scott, forget his last name now, but they own several $1 billion of multifamily, and he kept saying that the term survive till 25. So you think about, you have some of the largest multifamily owners in the country talking about, hey, it's our goal to figure out how we structure our debt, finance, rate caps in order to get to 2025, in order to ride through this, the incredibly volatile market, incredibly expensive debt market. So that's an issue, and not that I'm an economist and want to dive all in that today. I think more importantly, I want to the thing is, with a guy like Scott, who owns several $1 billion of real estate, great. They can maybe not do anything, not buy deals, kind of pause, they're taking fees on stuff. But for a lot of people listening to the show, that's just not possible, right? Like if you're a real estate investor, you're trying to make money in real estate deals, you can't just wait it out till 2025. Like you got to go
Yeah.
figure out, how do we find deals in today's market? And I think for those who are willing to make a shift and a pivot, I think it's possible. Um, and I've said this for a long time, syndication is not the answer. It's not the golden goose. I think it's been treated as the golden goose because it was easy to go out and raise funds for a long time. A lot of people had money. It was the trendy thing to do. Everybody wanted to be in multifamily, and that was great. But it's just like running ads on Instagram or Facebook. Like if Facebook goes away or Facebook's algorithm changes or ads get more expensive and you're so dependent on Facebook advertising, your business is going to really suffer. And I think it's the same way for folks who've just solely been dependent on syndication. It's like syndication is a vehicle, right? It's a tool that we have as investors in our tool belt to go get deals done. In this environment, man, we got to go figure out different ways to get deals done. It's harder to do. It's harder to raise money. It's harder to syndicate properties. And so, for that reason, I'm still bullish on real estate. Is it take more effort right now? Yes. But I'd also say this for those who are in the market and stay in the market and are looking at deals and making offers, even if it's slow over the next 18, 24 months, if you can survive in this, man, you can survive in anything, right? And some of the best companies, literally some of the top companies in the S&P were started in recessions. And I think that should give, there's something to that, right? Like the big companies on today's S&P 500, majority of them, like 40% of them, Kevin, I know that's not majority, but that's a good freaking chunk, like 45%
Of
were started in a
companies.
recession.
Yeah.
I mean, that's
talking
there's
220
something
companies,
to that.
you know?
Yeah.
So yeah, Ellis, this is really, really kind of interesting conversation, and not to be all like doom and gloom and real estate is dead and all of this stuff. But like you said, syndication, if you're a general partner on a deal, right? Syndication is a tool in your tool belt to raise capital. Remember, you're pooling funds together to go and raise capital. The problem, and just to restate the problem for a lot of folks who may not be tracking this, is that, like you alluded to, it kind of got like sexy syndication and everyone started doing it. And when everyone starts doing something, it doesn't mean that it's like lame and uncool and all of this stuff. It just means that there's more competition in the market. But ultimately, if you have people who are doing things that are unexperienced in doing them, they're going to be liable to take more risks that an experienced investor and an experienced general partner would say, nah, this is not for me. This doesn't make sense. There's a red flag here. This is not for me. Where the other person, just simply out of a lack of experience, they don't know. They don't know it's a red flag, and then they don't figure it out until 12 months into the deal, and they're like, "Uh-oh, this is bad." Or, like you mentioned earlier, a circumstance change that's out of their control, like, I don't know, the market and interest rates rising and all of this stuff. So, what do you think about kind of what's been happening in general with syndicators and that kind of that lack of experience and just kind of diving
Yeah.
in feet first? Has that made it harder for experienced operators to get deals, or is it just like, yeah, you can kind of take that and good luck?
Well, the issue is right now, I mean, listen, yeah, I think the world of syndication since the Job Act 2012, think about it. We've never had a true bear cycle, like a true downturn. So, I heard this joke, not that I'm in the world of real estate agents, but I was listening to another show a long time ago, and it was a woman out of New York, and she's probably top 3 real estate agents runs one of the top agencies in New York. And she was asked a question like, how did you become top 3? And she's like, I just survived for 50 years. It's like I just been through enough cycles where most folks come into this and don't survive. And we've stayed alive long enough. And dude, that's the same thing that's going to be true in the world of syndication, private equity, raising money. There's been a lot of people getting in this space, and there'll be a lot of people getting out of this space in the next 12 months, it's going to be hard to make money. It's, a lot of deals won't go well. They're going to lose a lot of trust. Folks don't know how to communicate in a downtime. And it's not to say like and here's the thing. I still think you can take a haircut or things happen in this time, it doesn't mean like everyone who doesn't lose is the only people that survive. No, I don't think that's true. I do think there are great operators out there, great investors who got caught up in one of the most historical, fastest interest rate rises in history. And I mean, even the Fed came out in January of this year and said, "Hey, the SOFR curve, or what we're looking at interest rates to be through the end of through January of 2024, was 1.5%. Today it's 5.5%, dude. Like, there's massive banks. First Republic, an incredible company that no longer is a company anymore. Like, so you think about that of, I'm not going to say it's not their fault, but at the same time, like, I think there's folks who are not going to do well and can still survive. But you gotta communicate. You gotta be open, right? You can't go to a hole, and you gotta persevere, and you gotta figure out a pivot in this season. So that's what I would say to that. I think the big problem right now, though, man, has nothing to do with inexperience or experience. It's just transaction volume, right? And so it's transaction volume, and it's very, very skeptical capital, especially when it comes to multifamily. So transaction volume, we transact in Dallas. And so you look at Dallas, man, from a year-to-year basis, transaction volume is down 80%. Wow. So you think about from January of last year, or whatever we're in today, June of this year. And I would say transaction volume started to really fall off because we were in the market. But let's just say January to January, I think the number was 70%. In January of last year, compared to today, you have 30% of the deals on market today in the same amount of buyers. Right. And then most of those deals aren't even great deals, because a lot of those deals can't even pencil, because now not only do you have 30% of the deals on market, dude, your cost of debt is significantly higher, and your equity, right, is very skeptical, because who wants a 15%, blended return when they can go get 4 or 5% in bonds, right? Rolling bonds right now. So, it's tough. The other thing, and then I talk about, skeptical capital, is like, people don't just want, and a lot of those 15 to 20% IRRs were coming from, hey, my rents are going to go up. There's appreciation in the market, cap rates expanding. It's really hard to pencil any of that right now, because in even top markets like Dallas, I mean, look, Austin, Phoenix, bro, they were the fastest rental markets in the country. Today, they're the fastest declining rental markets. We're talking 10 to 15% rent decreases in Austin and Phoenix right now. And in markets like Dallas, you're not going to get you're not even going to get 5% probably the next 12 to 24 months. You're probably looking at steady 2 to 3% rent growth. And so those 15 to 20% IRRs that people are penciling, you can't just assume I'm going to go get that in today's market.
Yeah. That's really, really interesting to think. And I was on a call with folks in my mastermind, and we were talking a lot about, what the next 12 to 24 months are going to look like. And for folks listening to this podcast who think that we aren't going to be in a recession, we're already in it. So, like, it's here, and it's just not, the media isn't pumping that out because that word scares people. And, but, think about what's happening at the peak or the beginning of any recessionary cycle. Banks and financial institutions start closing. Okay, that's already started to happen. Interest rates start rising, which forces a lot of the banks and stuff to close. So maybe the interest rates started going up first, got that out of order. But then a lot of companies start laying off a lot of people. Well, tech has been laying off a lot of people, like a lot of people. So, and if you look at the S&P 500, the top 10 companies there are all tech. The top 10 producers of the S&P 500, they're all tech. And they make up, like, I don't know, like 80% of the gains of the S&P 500. Like, the S&P 500 is running at like a 10% gain this year, but 8 out of 10 of those points come from like Amazon and Google and like all these other things. The other, 490 companies are like staying flat pretty much. And that's just how it goes, because tech happens to be very high margin, but they're still laying off a lot of people. So if you're invested in these high tech markets like Austin, it makes total sense that rent is taking a 15% year over year dive, because people can't afford that rent anymore if they're losing their jobs, or they're they don't have that stability anymore. So it totally makes sense. What I'm curious to see, and usually what happens during a recession historically is a lot of investment internally within the United States, like internal investments in things like manufacturing. If you've been following the news, you know that we're competing with China for chip manufacturing, and that it's this administration's, keeping politics aside, but the current administration has made a big push to internalize chip manufacturing within the United States, because that is a huge asset to us to have that. So a lot of the times what happens is imports and exports kind of go down. We're not importing a lot as much, technology and goods, and we're focused more on internal GDP growth and figuring out how that works. Well, manufacturing, internal manufacturing, that's going to be huge. So when we talk about pivots, and I will pivot into this next conversation, that's called a segue, people. That's what that's called. You segue into a conversation. We pivot into this topic. For me, man, I'm looking at industrial, light industrial. I'm looking at real estate assets that can whether it's storage, but even that's a little bit overplayed. But I'm curious, on your opinion on some of these alternative assets to multifamily that folks can take a look at and get involved with, that might be better catered, better suited for a recession.
Yeah, I mean, I think there's some great ones. I see a lot of folks kind of pivoting if they're at capital allocators into oil and gas, industrial, all of that is great. However, as a small operator, and by small, I mean, maybe you're a 1 to 2 person shop, right? You can go out and raise a few hundred to a few $1,000,000. You don't have a big team to just kind of go make a pivot and go learn oil and gas, go learn industrial. Because, dude, you're not just gonna like say I'm gonna pivot and go do industrial in the next 12 to 18 months if you don't have track record in the market, because it's not like those things weren't competitive beforehand, right? And the fact that you're talking about it now means a lot more people are talking about it, and it just becomes more competitive. So I would say, like, I think that's true. And if you have the privilege and the ability to be able to pivot, and maybe you're just talking about as an allocator of capital, that's one thing. However, for the folks who are just saying, I'm just trying to go get deals done right now, I would caution them to maybe not think so much in terms of go to new asset classes. You do have to I guess the solution, like, what is the solution then? And I would say, if you're in multifamily, I think it's okay to stay in multifamily, Kevin. Like, I think multifamily will be fine fundamentally in good markets, right, where there's good growth. I think the big thing we're teaching now, where I'm seeing a lot of people get success with, is we got fat and happy from a marketed deal standpoint, right? Like, there were a lot of deals transacting, and a lot of deals were transacting because equity was growing and multiplying, value added plans were working. People were able to hit their multiples early, and so deals were just flying. Like, hey, I don't need to own this deal for 5 years. I've already hit my multiple in a year and a half, 2 years. So what can I go do? Well, now I have the privilege to go sell that deal. That's not happening right now. People have to go operate this kind of stuff, right? It's going to take a 3 to 5 to 7 year cycle in order for that to happen. And so that means less deals are going to transact. So what do we then do? Like, well, I think the solution here is two things. Is one, those who are going to survive are going to pivot and really get good at finding off-market deals. And so I don't think so much of changing asset classes as you need to put more tools in your tool belt in terms of, hey, you were dependent on brokers in this last season. Great. It's time to maybe lower your criteria a little bit in type of deal size. So maybe if you were focused on 50 to 100 unit deals, maybe you're looking at 10 to 30 unit deals now. And that's going to open up your criteria. There's a lot more deals now in that 10 to 30 unit space, right? And instead of going through a broker, now you have the opportunity to go direct to seller. And so, do you have a marketing plan? Do you know how to market off? Do you know how to go find seller leads? Do you know how to market those seller leads? Do you have a system and process to reach those off market sellers? I've found that it takes about 6 to 9 touches, and that's 6 to 9 touches, and those could be email, mail, text, phone call. Typically, a phone call is definitely involved in this process, almost always, in order to go do that deal. And so those 6 to 9 touches, man, are going to take you about 7 to 10 months, right? Like, it takes, you can't just go, hey, okay, 6 touches, I'm going to call them 6 times this week. No, 6 to 9 touches will take you about 7 to 10 months, right? So realize that. And that doesn't mean you're buying all of those deals. So I think that's a big pivot, is really focusing on how do we shrink our criteria? How do we go smaller unit size? How do we go less? Because think about it. If you're a buyer who's buying 50 to 100 unit deals, and now you come down to a market of 10 to 30 units, you're pretty sophisticated. Like, you know a lot that those owners and other buyers don't know, right? You know a lot more about debt. You know a lot more about finance. You know a lot more about operations and technology. So I think you bring a lot of advantage to that. The other thing, man, the other problem is capital, right? Is people are very skeptical. They know that you can't just depend on rent increases and appreciation and cap rate expansions. So you got to have like if you're going to be a multifamily, you can't just say, "Oh, I'm in multifamily," like just like, a year ago, like everyone's like, "Oh, multifamily's the goat," like this is going to go forever. People know that's not going to happen. So the only way to create, people like investors always want to know what's the one or two things that makes this deal click, right? Like, what is that? It's really hard to do that on all market deals right now, because before you could say, well, rent growth, you could say job diversity, you could say the market's growing. Hard to say that in any market right now. So you got to go find, maybe you're buying at a good basis. Maybe the seller is an older seller, right? And they truly haven't raised rents in 3 to 4 years. There's just more plays there that I think when you go to a smaller market size and you expand your deal criteria and you're going direct to seller, there's a lot more things that become attractive to investors that you can find operationally versus just saying the market's going to grow. And so I think the pivot, man, that's going to solve for a lot of people who are willing to go do this work. And this is not easy work, dude. This is why, this is to go, because you're going to have to get data, and you're going to have to go pull that data, and you're going to have to build a marketing plan to that data. And then you're going to have to go call that data. And I say data, this is leads. And by the way, all of this is public. If you want, we can walk through that today. But that's the pivot I think I would recommend for most people, because it's more work, in my opinion, to go do a new asset class, because you have to learn that asset class, how to underwrite it, how to operate it. If you're already in multifamily, don't go nowhere, because most of the people won't make it anyway. So now your competition has already decreased. And if you can get through this, and you can add another tool to your tool belt of learning how to find off market leads, go direct to seller, potentially how to do creative finance on some of these properties, right? Where you're not working through a traditional bank. Maybe you're doing seller finance, seller carries. Now you're adding more tools to your tool belt. You're just becoming a better investor through this. And for those who are willing to kind of pick up those tools and maybe part of a community like yours or mine, Kevin, that are, around people who are doing this type of stuff, that's going to be the people that thrive and survive through this, man, and come out of this in 2025. And, when things open back up, are still doing deals.
Yeah. And you're still doing deals. And if you're able to go and get one of those creative deals done, or now, or prior to 25, when a lot of people are thinking that things are going to begin to regulate again and we're going to pull ourselves out of this, that deal is even going to be more valuable, right?
Yeah.
You'll be able to ride an upcycle, that you always want to, buy low and sell high. And, in a lot of the big markets, Ellis, I'm curious what you've been seeing. I've been seeing a lot of the big markets, prices remaining, they're not coming down on multifamily assets. They're just kind of remaining flat. And sellers are just like, they're adopting that mentality. They're like, well, I really wanted to sell. I wanted to get out of this, but I guess I'll just kind of stick it out. And, but in some of these smaller markets, they might not have that luxury. Like, they could be mom and pop owners and they're old and it's been in the family, or they could be business partners who are going through, like, don't want to be business partners anymore. You see that a lot. And there's even opportunity. One of the members that I know, a mastermind and buddy of mine, he went and purchased, I think it's like a 109 unit deal, but the sellers actually became a primary LP in the deal. It was just a creative way for them to get the deal done. They didn't have the money, they didn't have the appetite to go and do all the renovations that needed to happen and do the value add. And it's just one of those classic deals that just hasn't been touched in a long time. Yeah. And,
they're
like,
older,
hey,
they're like,
involved.
yeah, we're not going to go do that 100%, and you think about it, you're not going to go have that conversation with a institutional owner or even a big syndicator, right, who has thousands of, like, you're not going to come to me and buy one of our deals and say, oh, you guys want to stay in as an LP? It's like, no, we need to get our money out because we're going to go pay investors. And so the only way to have deals like that, to your point, is you gotta open up your criteria. And by open up criteria, I mean probably going a little bit smaller. And so, yeah, I mean, that's where unique things can happen.
Yeah.
And, I think for most people listen to the show, myself included, is, and think about this is, if you're buying deals like this, I know 10 to 30, they're typically smaller purchase size, but if you don't have to bring in a bunch of outside equity to close these deals because you're doing something more creative and you own a bigger percentage of that deal, the profit back to you can work out very similar. Where, if you own a 100, 200 unit apartment building, but you're a 10% owner, and now you're an 80% owner on a 10 unit building,
Mm-hmm.
that's still going to be really good for a lot of folks. And so I don't think it takes, again, man, to your point, and I do love that, a guy like you with your network and skill probably has the ability to shift asset classes or go look at something different. You're an allocator of capital, you guys have your fund. That makes a lot of sense. But I think for the normal person probably listening to this show, just trying to get deals done, to just stick with it, I think is like the if we're going to title this show as Real Estate Syndication Dead, it's crippling along right now. And for a lot of syndicators, yeah, they're going to die. But I think for those who are able to pivot and add some more tools into their tool belt, when syndication is not necessarily the main vehicle, it will come back. Like, it's a growing industry, right? People need places to put their money, alternative assets. Syndication is not going anywhere.
Yeah. And it's
But
funny you
in
bring
this
that up.
market, it's probably not the sexy Ferrari right now. You know what I'm saying?
Mm-hmm.
It's, you need to park it and you need to go do something else.
Yeah. It's funny you say it, because we talk about syndication being a tool in your tool belt, and you see a lot of sophisticated investors, and I mean, like, not just in a definition sophisticated investor, but accredited investors who have been around the block, who are now more interested. Nah, I don't really want to get in. I don't want to be an LP. I'd rather be a co-GP. I'd rather, or I'd rather joint venture, or because they understand what you were just explaining is that equity split is, on owning 80% of that 10 unit, it might be more valuable to someone than owning 10% of a 200 unit,
Yep.
or being an LP in a deal. And that's with our fund, that's primarily what we do. We co-GP, the fund co-GPs with, you know, with operators, and we're able to own a significant, 70 to 80% of that asset, which is really, really awesome. And, we're able to capitalize on that equity. So it's really, really interesting, that to me, it's kind of exactly what you're saying, Ellis. It's about adding more tools to your tool belt and figuring out, okay, let's stick with it, but let's figure out a way to be more creative, because going to the brokers right now, it's not necessarily the best option, or the deals that you're getting from brokers are just like crap. Like, they're total
Mm-hmm.
crap deals. And honestly, to be a broker right now has got to be really, really difficult, because it's
Yeah,
just
I mean,
not like it was.
that's another great, I mean, brokerage is the same way. Like, there's going to be a lot less competition in brokerage after this too. It's like one of those things, you hope you've put some money away if you're in the brokerage community, because be a lot less brokers. And again, like, this is good. Like, this is capitalism. Like, this is, if there are no losers, there are no winners. And I think this is healthy. And so there's nothing wrong with this. Like, this is a cycle, and this is what happens. People lose, people win. What's interesting, and we'll see, like, how big of losers there will really be. I think we've seen already kind of the Fed and backstopping a lot of these failed banks, for example. Like, I don't think there's going to be as many losers as there might have been, back in the 40s or 50s or 60s, because of, just our ability to just print capital, print money today. However, my point is, this is normal, man. This is cyclical, and this is an industry that's had a really, really, really good run for the last 12 to 14 years. And we're facing real contraction and real hurt, and that's just going to happen. Like you can't get away from it. It's going to happen. And so, however, I think again, now is the time though. It's not just, well, let me just sit back for 2 years. No, for those who really will, keep their foot on the gas and, start to really build their relationships with owners, sellers, these brokers who are sticking around. That's what we're encouraging folks to do because, if you're committed to doing this, and we both believe that real estate is a long-term game and that it is the most sure and predictable way to build wealth, well, then you know that 2 or 3 years is just a blimp. Like it's just a blip. Like you're going to look back and it's a blip,
Well,
and
you're
so
going to
to
be
have that
grateful that you went
perspective,
through that cycle. Yeah, exactly. To have that
100%.
perspective. Yeah, you're going to
Yeah.
be super, super grateful that you're able to push through and find that out. So for people listening to this podcast, Ellis, what are some ways that we touched on creative finance, and we touched on maybe seller finance, seller carry. What are some ways that people can go about and just go out and get deals and make these calls and do all this stuff? But how can they differentiate themselves amongst, non-experienced investors?
Yeah. Well, I would start with a good data source. So there's plenty of great data out there today. There's Reonomy, which I really recommend. You can get a service like Reonomy, a couple $100 a month. You can get a 7-day free trial on Reonomy. And just like I would always recommend people go get a 7 free day trial on Reonomy and just start looking around your local area and filter by what I'm talking about, 10 to 100 unit deals, and just see how many properties are around you. And if there's not a good data size, like if there's not several hundred of those around you, maybe expand your market, right? How many other markets can you combine? Or maybe you can go to a neighboring market and then you can, because this is not going to work in a market where there's 20 or 30 apartment deals, right? Like that's just not a big enough data set.
Not enough volume. Yeah.
Right. So you need a bigger data set than that. So I like finding a market where there's, over 500 apartment deals. I say deals, like just apartments within your criteria, 10 to 100 units. And this is going to give you a good data set. And then again, when I say set you apart, it's funny, man. I personally, I think there's a lot of cool things I've seen in our community do. Like somebody will send a personal note with like an ice cream shop gift card and stuff to it, which I think, is different and probably different from what someone has seen. But what really makes you different? Just freaking consistency. Like and I think about this is true in sales. This is true in marketing. This is true in real estate leads. If it takes 6 to 9 touches to get a deal done, and most people stop at 2 or 3, who's actually different? You know what I'm saying? It's the people who go 4, 5, 6, 7, 8. And I think that is the biggest thing. It's just like, do you have a systematic plan built out that when you're tired and you don't feel like sending out mailers, or you don't send out doing another phone call or putting out another email, you have a system and team in place that can just do that for you. And you don't give up. And I think that is the biggest way to stand out. Yes, there are some creative ways you can, when you find a deal you really like, you could do the FedEx priority mail, and that way, like, it's going to get hand delivered to them, and they have to open it up. Like that's something that I've seen done. So there are some cool things like that to do. But the big thing, man, is just top of mind, right? Like it is. I'll give you a great example. We had hail hit one of our properties the other day, and there's 10 billion of these insurance claimer guys who will come out and change your route. Like they're making like 60-70% margin on this stuff, right? Like
Wow.
These insurance claim guys, they're making a lot. I know, because they'll like offer me like 40% of the profit margin just to do my own roof. I'm like, dude, just give me a good price. And I'm friends with like a dozen of them. Okay. So I know there's a lot more, because I have friends I have a dozen friends in this industry. So, there's probably, 10 dozen actual companies, and the company we'll likely go with, man, is just the company that's just been there, and then they were the first one on the property, right? When the hail hit, they were top of mind. They were leading the charge. And so I do think, that's just an example of like the person that sticks out is not necessarily always the best or most affordable or the best price or the best offer or gives the best gift card. It's just like, who was the person that was there consistently, who built a relationship I emotionally feel tied to and has been persistent, and that's going to win the day. Like, because that's what you can scale. That's literally what you can scale. You can't scale being the most charismatic. You can't necessarily scale giving them a gift, finding the right gift for everybody. But you can scale consistency over time. That's something you can do over and over. And so I think that's a big one.
Yeah, no, I love that, man. And you think about that, and just in the context of this podcast, like we talked about at the top of the show. I mean, I've been doing this for years, years and years and years, and it's become automatic for me. But when it comes down to it, it's every single week a podcast episode comes out, and I'll have to give a shout out right now to one of our longtime listeners, Cole. Recently, I had a conversation with Cole. He was interested in investing in the fund at ADPI Capital, and we had this conversation. And I called him, and I was like, "Hey, Cole, what's up, man? It's Kevin Brenner from ADPI Capital." And he's like, "Can I call you back?" And I was like, "Sure, whatever." And he calls me back like 20 minutes later, and he's like, "I didn't actually believe it was you, so I hung up the phone." He's like, "I've listened to every one of your podcast episodes.
That's
I'm a
awesome.
huge fan." And he's like, I didn't think that you would actually call to talk to me about whatever I was interested in capital and the fund and this, that, and the other." And we got to talking and all of this stuff. And he's like, "Yeah, I literally told my wife when I hung up on you, I was like, I think I just hung up on my hero." He's like, "This is the dumbest thing I've ever done." But it was like an instant panic. Who is this? Hang up. But yeah, Cole, thanks for calling me back.
What up,
Man.
Cole?
Yeah, there he is. But that's, that level of consistency is what it takes if you're building a brand, you're building a company, you're building a name, blah, 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 blah. But just having the opportunity to talk to great people like Ellis and hundreds of others on this podcast has made me a better investor, made me more knowledgeable, expanded my network, and helped grow just the active duty passive income conglomerate now. I don't know.
Yeah.
Conglomerate's not the right word, but it sounds like an evil like death ship kind of a thing, the Death Star.
A very recognizable brand. And
yeah, very recognizable brand.
For sure.
Exactly. But yeah, like when we, just bringing this back to kind of real estate and where we are, there are a lot of ways to get things done in today's market. And Ellis, you did a great job of explaining, kind of how to be consistent and how to some creative ideas on how to get deals done and how to get in front of prospective sellers. But you're absolutely right. You need the data, you need the system, and then you just need the hustle. And that has never changed. Whether you're in an up market or a down market, you still need the hustle. Because guess what? When you're in an up market, there's a heck of a lot more competition. When you're in a down market, it's just less competition, but just harder to get in front of people. So there's always different variables that are like, if you think of like a bar chart or different levers being pulled, always different variables depending on the market cycle that you're in. But if you can survive this market, this cycle, then you're going to add so much to your tool belt. Like we talked about at the top of the show, you're going to be so like that much better of a real estate investor. And it's going to help your investors. It's going to help you personally. And yeah, it's just a matter of making small pivots along the way. And in the grand scheme of things, that's ultimately what it's all about. Because investing is just a means to an end, right? It's a means to time freedom. It's a means to wealth, and it's a means to making a greater impact and something that's bigger than you. And that's why we do it. So if you have those core values aligned, then you're gonna be okay. It's just a matter of changing how you approach things and maybe being a little bit more out front when it talks to coming to sellers. And one last thing, Ellis, I'm curious, how important is a story when you're talking to a seller? How important is your story, your origin, or your experience, or the deal story when you're communicating that to prospective investors?
Yeah, I mean, that's a loaded question. I mean, I think story's everything. It's hard to find a blue ocean in any industry today. And I think the way to create, I think of me when I came on this path. I was a pastor before this,
Mhm.
not much experience in real estate or raising money except for raising, funds for our nonprofit. And it was a story. It's always been my story that's allowed me to build everything from our capital raising company to our mastermind community, education community. Like we've you could say leveraged this story of going from ministry and into real estate and the kingdom impact that we want to have in order to go do that, right? Like that's my whole brand is that,
Mhm.
and I think the same way when you're talking to sellers, man, people are emotional, and yeah, people want the best price, but you know, people don't want to just sell their deal to anybody. They want to sell it to someone they know that cares and has a good story and is trying to build a good life for them and their family. And so I think it's really, really important, and that could be as simple as just in your letter you send out, instead of kind of the old, bland, hey, I like your deal, I want to buy it for this price. Like, put a picture of you and your family, right? Like, make it personal. People want to do business with people. And so I think story is so key. I mean, I think it's definitely important in finding deals. I think it is necessary in raising capital, is what I would say.
Yeah, yeah, and it's absolutely necessary in raising capital. It's what we've learned. I've known and we've learned with ADPI Capital and Equity Fund One and all of that. But it's like the that that story is so important. And when you're doing direct to seller, that's where the story really kicks in. Because if you're working with an intermediary, if it's a 1 to 4 unit, you're looking at the real estate agents, right? Or you're talking commercial and you're working with a broker, they don't communicate that story for you.
Mm-hmm.
But when you're in an environment where you have to go direct to seller, like what we're seeing now, or you don't have to, but it's becoming that way, right? You got to get creative. That you're interacting with them, they're interacting with you. And at the end of the day, yeah, price is obviously important. It's important to them, and people get emotional over price, sometimes too emotional over price. But if you have those 8, 9, 10 touch points and you're able to develop a relationship, yeah, you might not get this deal, but you might find out that they have another 20 or 30 units somewhere else, or they have this over there, or they
Exactly.
know someone who does.
Yeah.
And that's what it's all about.
Yeah.
Because if you're a good human being with a good story and a sound purpose and a good head on your shoulders, people are going to want to do business with you. And
Yeah.
business is relationships, relationships is business. And I know I'm like, we're both broad brushing this and saying, oh yeah, it's just super easy to create this story. Like, you're not like, you know, the story is not something that's fabricated. It's literally you. Every person listening to this podcast has a unique story. We are all snowflakes, and that's okay. That's a good thing, because otherwise life would be pretty damn boring if everyone were the same.
Yeah. Yeah. It's a good
So,
word, man. Totally agree.
uh, all right, man. Well, I think it's time to take you to the bonus round.
Mm,
Uh,
I
it's
love a
we
good
we
bonus round.
I love a good bonus round, and we've probably been here, but it's been 3 years. And I'd venture to guess that some things may have changed in these questions. Well, at least two of them definitely changed, I hope.
Yeah.
So we'll start with question number 1 for you, Ellis.
Okay.
What book or software has really been crushing it for you lately?
What book or software has really been crushing it for me lately? Um, mm, I tell you what, man. In terms of a book, I'll give you both. Real quick though, it's the summertime, so I'm listening to a little bit of fiction stuff. So the
Mhm.
Maze Runner
Oh,
is the
that's a good
book that I
book.
put in at night, and dude, I just go to sleep because it's a good story. Also a film, and
Yeah.
so if you guys haven't seen the Maze Runner trilogy, highly recommend it. And so I liked it so much. I'm gonna go read the book. So I'm really enjoying the book. It's been great. And then I mentioned Reonomy. I mean, I think again I encourage folks to at least go. I don't even have a link for that. I just like their software. A lot of
Yeah.
people in our community use it, and so Reonomy.com is a great one. If you're serious about going off market and doing something different, making this pivot, I would say I would recommend that.
Yeah. No, that's great. And we're going to have links to Reonomy. And like we said, we don't have an affiliate relationship. Ellis doesn't have an affiliate relationship, but you can just click on the link in
I'm
the show
working
notes.
on one. If I had one, I'd give it to you.
Yeah,
But
I
I
know.
just don't
I
have
know
one.
it.
So
Maybe by the time this is published, Ellis will have an
yeah,
affiliate
yeah,
relationship. We'll
yeah.
change the link. But yeah, I mean, and I have their software pulled up right now, and it's super cool. It's for commercial properties, and it's a
Hmm.
data source, but it's exactly what you need. If you have your market identified and you have your criteria identified, then it's like, okay, well, let's look at what's out there and let's start working these touch points. And
Hmm.
if you have capital raising experience, you understand that before it was like 7 touch points. Now it's like 9 to 13 touch points. But like having that system built, it's all the same stuff. It's marketing, right? It's literally the same. So it's just has a different purpose. So check that software out. It should be pretty cool. Question number 2 for you, Ellis. Who's your biggest hero and why?
Dude, right now, I think there's 2 people that come to mind. One is I just had a big debate with my sister-in-law about this guy, is Elon Musk. And I just really, he takes a lot of heat for a lot of different things and stances, but I just appreciate a guy who has a backbone and a guy who he could do anything he wanted. He could take off. He has as much money as he wants, and he continues to create and innovate and, take a stance for something, regardless of whether you believe in it or not. And so I really, that's inspiring. I think we need more people who, care less about the dollar in front of their name and, what I'm going to do with it. And I think he's on a good trajectory of what he plans to do with it and help the world. The other one is my wife. We're potty training right now, and we have a 12-week-old. And so,
Oh,
bro,
congratulations. That's a brand new baby.
and it's like, it's so much easier for me to come down here and do podcast shows and talk about real estate than it is to like potty train and take care of a 12-week-old. So I'm grateful for her. So shout out to my wife.
Yeah, I bet that. Now I'm picturing you like taking this podcast, but you're like on like a kiddie potty.
Yeah.
You're like
I'm probably going to go up, dude. It's going to be like, oh, yeah, get done with this. I'm going to go force a 2-year-old to go pee on the potty. So that's my life.
Oh man, that's awesome. Question number 3 for you, lightening up a little bit. What do you like to do for fun these days, my friend?
Bro, I'm all part of the rage, man. It got me like it's gotten so many other people.
Don't tell me. Is it
Pickleball, man. It is there. I legitimately I bought 2 entire sets, and I've been hosting, or I hosted my first pickleball day down the street from my house, and we marketed it to our investor base and everybody. It was so fun, man. So I legitimately have like my own net, balls, paddles. Like I could host the neighborhood for pickleball. So it's fun, man. I'm so competitive, and it's it's one of those games that like you can go out and just like play, or you can go out there and like play. You know what I'm saying? And so that's been cool.
I woke up this morning, so I played yesterday. And in DC, there's so much. Like I started playing like in the beginning of COVID, and when we used to go out there, it was literally just like 3 or 4 guys. It was like the same 4 guys. We would text each other, hey, you want to go out? No one even knew what the court was for. Like no one knew. Now we'll go there. There's 60 people trying to play, and we've expanded it. There's like 8 courts now. So you get some games in, but it's just crazy.
That's cool.
I went out to play yesterday, and I woke up this morning like, man, my back. My wife and I were on a run around the mall, the National Mall, and man, my back hurts. Like, what did my back hurt? And she's like, what's wrong with your back? And I was like, I think it's from pickleball. She's like, you try too hard at that.
Dude, it's one of those games you get into it. Yeah, man, we played all that Saturday, and then I played again, and then I finally went out the next day. I'm like, man, my ankles, and
I know.
Give mad props to guys like Jimmy Butler, who are 36, 37 years old, just playing every other night in the finals. It's like shows, man. Like those guys are legit, 1%
professional athletes. Yeah, exactly.
Yeah.
But I figure by taking a stance in pickleball as young as we are, we're gonna ride this out, man. Because there are like 75-year-olds who kick my ass.
Yeah.
Legitimately.
Yeah. Maybe this is a game you age in. I do watch a lot of like, now that I'm into it, like I get hit with a lot of stuff on Instagram, and I watch these pickle volleys. And bro, most of these pickle volleys, you're standing at the net. Like, so you could get good. once you get good, it's a net game, right? It's what I'm learning. Like it's all about the net game. And so, we'll play,
we're gonna
man.
have
We'll
to
get
have
you out
you
here to
back
San
on.
Diego. Yeah.
Part 3 is just going to be all about pickleball. We're not even going to talk about
Yeah. We could talk about it, man. I'm learning a lot. 3 years from now, I'll probably be out of real estate and just full-time pickleball.
Full time.
Yeah.
Oh man, that's awesome. All right. Question number 4 for you. Arguably the most important question. Well, maybe the second most important after the pickleball answer. For folks who, they've been listening to this, that they're like, is syndication dead? And, we talked about a lot of nuggets, a lot of ways to pivot and all of this. If you had to summarize into 3 nuggets of wisdom that you can share with people on how they could find success in an impending recession, what would that be?
Yeah, the 2 things, man. I mean, I've been out of business, almost out of business a few times, and I haven't been in business that long. So it should it says a lot of things about me. But the thing it definitely shares about me is that I've persevered. And the 2 things that have helped me is, one is a mentality of like, don't quit. Like if you just when it's hard, just remind yourself, like, I'm not a quitter. I will not quit. I will not quit. I will not quit. Pick yourself up. And when you pick yourself up, realize you got to pivot, right? What you're doing is not working. So it's okay to pivot. You're not quitting when you pivot. You're making a strategic pivot. And so I think a lot of what we talked about today is a strategic pivot that a lot of people need to make. And third is, man, surround yourself with people who know what they're doing. Like, this is not rocket science, right? Like, it's real estate investing. And so if you're not part of a community, or you have mentors, or you're not, go follow, like, people have already created this system, created this process. And so go copy it. Like, don't try and be the genius in the room, right? Like, go find other geniuses and copy what works. And so that's what I've done, man, for most of our companies, and just still do that today. And, I find people that are doing it better than me, and I try and learn from them and take what they're doing and, make it in my own way. And it's worked up to this point. And so I would just say, don't quit, pivot, and find other great people to learn from, and just, try and copy a lot of what they're doing.
Yeah. There's no need to reinvent the wheel, because like we said, this is all cyclical. People have seen it before. And it's just getting in touch with those people and finding out, hey, when you saw this before, what are you seeing in this? And that's why we always say real estate's a team sport, because it totally, totally is. Ellis Hammond, thank you so much for coming back on the show. How can folks listening to this podcast, maybe they're in the San Diego area, get in touch with you for your neighborhood pickleball meetups? Or
I'm in Point Loma. Yeah, for sure, man. You can hit me on Instagram if you want to come play pickleball. 2 things. So I have a podcast as well, the Kingdom REI podcast. So if you like listening to podcasts, we just interviewed, I saw you had Ryan Pineda. I just interviewed him, and we are a kingdom minded show. So we got to talk about a lot of things, man, about his faith and the Holy Spirit. And then we talked about real estate as well. So if you're into that kind of stuff, I think our show is unique. And like this, we just kind of talk about the things that we find interesting, which are God and real estate. And so the podcast, and then, man, I have a 2-hour webinar online where I talk about breaking into commercial real estate. And one of those is finding deals. And so that's oneconnectionaway.com. If folks are interested in just taking a deeper dive into some of these topics we chatted about today, it's free. It's just about a 2-hour webinar where we dive deep into some of this. So oneconnectionaway.com is the link for that.
And is it the number 1, or is it like,
no, it's all spelled out. Yeah. ONE.
Okay, all spelled out. Okay. So we're going to have that linked in the show notes as well. So if you want to catch that webinar, or we'll also have a link to Ellis's podcast, we can get more of Ellis. Man, this has been, it's been really cool to have you back on, and I love it. I love every minute of it. We share a lot of knowledge. And we're going to have to do it another 3 years, hopefully sooner. All right. I'll talk to you next time, dude.
See you.